Investors. I'm your host, George Gammon. And what I do is I take a look at the headlines that caught my attention from the week prior, and I discuss in 20 to 30 minutes weekly how I think that affects real estate investors. So let's dive right into it here. I saw a lot of headlines last week for Elizabeth Warren's wealth tax and how it's gaining a lot of popularity. And now you can see over 60% of voters, including half Republicans, support her wealth tax, which is not really her wealth tax. It's nothing new. And what this is a 1% tax on your wealth. So as real estate investors, I know you've probably just been hyper-focused on your business or getting deals, closing deals, selling properties, remodeling, whatever it is. And you've kind of heard this as background noise and haven't really thought about it. But this is really a big deal for everyone here. And why this is a big deal, because a lot of times, or most of the time, real estate investors are asset rich and cash poor. They've got all of their net worth into properties that may only be producing a 3, 4, 5% yield. So if you've got a $10 million portfolio and let's say you're getting a 4 or 5% yield, you're making $500,000 on that, then you're being taxed on that, an income tax, and state and local, and then you're paying sales tax and all these other taxes combined. Well, what she wants to do is say, okay, well, you're worth 10 million bucks, so you need to pay an additional 100,000, 1%, every single year. And every single year, we need to revalue what you're worth, and then you pay 1% of that. So let's say your portfolio goes up by 50% just due to inflation or or appreciation or whatever it is. They revalue that, and then if your portfolio goes from 10 million up to 15 million, well, now you're taxed at 1% of 15 million. So as real estate investors who are quite often asset rich and cash poor, you can see how this would be a really, really big problem. And it also applies to a lot of businesses that are in the same boat. Won't go into that. But you could be saying to yourself, well, George, this isn't a big deal. It doesn't apply to me because Elizabeth Warren's tax is only affecting people who make 50 million and more. And my reply to that would be, okay, you don't know your history of U.S. taxes. and more specifically, the income tax was implemented in 1913. And when it started, it was just for a very limited group of people. And that's how it was pitched. If they would have pitched it as an income tax for almost every single American, there's no way it ever would have passed. So they pitched it as a tax just on rich people. Sound familiar? And it was just 3%. And so, it passes. And the next thing you know, the income brackets gradually creep down, and the amount of money that you need to make to apply gradually creeps down. And the next thing you know, it's a tax on not only the rich, but maybe even more so on the middle class, because they're paying a much higher percent of their income that would go to living expenses. So I could break out the charts and the graphs to show this, but what I think does a really good job is to look at the 1040 form from 1913 and compare that to more modern times. I've got one from 2017. So let's look at that from 2013 real quick here. And you can see, first and foremost, that this form is a whopping, and this is the entire tax form, is a whopping, on here, those are the including the instructions, it's 4 pages. And then another thing that you'll notice, wouldn't that be nice? And another thing that you'll notice here is that you've got to put in your income, you've got to take your deductions, and then your net income needs to exceed $20,000 in order for this to apply to you. And remember, this is $20,000 in 1913. So let's break out our inflation calculator here, which I already put in the, the numbers. 1913, 20 grand is 500 grand. So this only applies to people that are making 500 grand or more. And since then, we all know what has happened. And then I'm not going to pull up the form for 2017 just for the sake of time, but it's 117 pages. 117 pages. And as you know, the rates have crept down, and the amount of people that are caught by this net of tax has grown from just a very, very small percentage of Americans to now the majority of Americans. And my point is that when this wealth tax is implemented, and I say when because I think there's a very high probability of it being implemented in the next 5 years or so. It doesn't mean that it's a certainty, but I think that there's a high probability. Is that my prediction, just based on history of U.S. taxes? Sure, it's going to start off at 50 million, but then it's going to go to 20, then it's going to go to 10, then it's going to go to a million, then it's going to go to 100,000. And that's just the way these things work. So if you're a real estate investor, be really cognizant of this, because a lot of times we are asset rich, but we're cash flow poor. The next thing that I wanted to discuss that really I started to think about and caught my attention was the rate of inflation. And I've done a couple videos recently, I think on the Facebook pages. I'm not sure if I shared them on YouTube, but it talks about how inflation can make you a lot of money, especially if you have a 30-year fixed rate mortgage. And I'm not going to go into that, but I got to thinking that, well, we base all of these inflation or all of the theories, and that whole investment thesis was around inflation, but it was using the CPI numbers that you get from the federal government. Well, what if those numbers are incorrect? I mean, that's a huge deal that I really don't think people really contemplate. And when I mean people, more specifically, I mean real estate investors. And I've talked about how I think the home prices in the United States are extremely high on a historical basis, but I could be wrong. And I think that there's a low probability that I'm wrong, but I always like to play devil's advocate with myself. And I wanted to give you guys kind of what's going on in my head, and just as food for thought. So what I mean, let's first of all start off with housing prices here. And you can see how housing prices adjusted for inflation are right about at the same levels they were in 2006. And we all know historically that was extremely high. And this chart is not it's not ideal, but you can see that if we start at 100 basis here, and this, we don't have it, but if you drew this line adjusted for inflation all the way back to 1900, it would pretty much be the same. And all of a sudden you just have this hockey stick growth in prices, which we all know was as a result of a credit bubble, really. Then that deflates, comes down here, and then now all of a sudden we're right back where we were. But this is using the CPI, the Consumer Price Index, as a way to adjust for inflation. But like I said earlier, if that number isn't right, then this isn't right. Like, it's not even close. So there's a website that I go to every once in a while, and it's shadowstats.com here. And they have a way of using methodologies that were in place in 1980 to give us an apples to apples comparison on what the CPI would be now. As some of you know, the CPI changes all the time on how the federal government measures the inflation rate. So, back in 1980, the way it was measured was a lot different. So a lot of people assume that it was just apples to apples, and it's always been that way. It's not. It's a very fluid number, and the government, if they want the number to be lower than it really is, they can massage the way that number is calculated to make inflation seem as though it's lower than it is. Why would they do that? Because remember, the United States government is the biggest debtor in history, in the history of the world. $23 trillion in on-balance sheet debt. So the only way to get rid of that debt is through default or inflation. So a higher rate of inflation is very beneficial to or to debtors. And I'm sorry, I said the United States government is the I'm not sure if I said they're the creditor nation or the debtor nation. I'm sorry, I'm getting over a cold here. But they're the largest debtor nation of all times. And inflation is advantageous for debtors because they pay the debt back in a currency that is worth less than what they borrowed. Okay, so bottom line is it's very beneficial for the US government to have inflation at a higher rate than people might think. So looking at the shadow stats here, this is if we were measuring inflation the same way now that we were measuring it in 1980, you can see the actual inflation rate here. This is the CPI number that we get from the government. Well, if we did it the same way in 1980, look at where the inflation rate would be. Isn't that crazy? Look at this. I mean, the inflation rate would be more than double what the government is actually telling us. So if it's more than double, just think about what that would do to home prices that were adjusted for inflation. If the inflation rate is a lot higher, then this number would be substantially lower. And again, remember that the inflation rate compounds. So if the inflation rate is 2% per year, well, it goes from 100 to 102. The next year is not 104 because the next year would go up by 2% of 102, not 100. So you've got this compounding effect. I don't know exactly, but my guess would be if the shadow stats are correct, that prices might be closer to here than here. And that is still quite a bit above our trend line. And I would say that prices are still historically expensive, but nowhere near as expensive as they look if the CPI is, or if the real home prices are adjusted for the current CPI, the numbers that we get from the government. So I'm always talking about how expensive stuff is in the United States, or how expensive home prices are in the United States. But this is kind of a counter to that argument. And I think it's healthy that we always challenge our opinions. And this is one way that I challenged my own opinions. And I really started to think about this week. So I wanted to go over that with everyone. The last thing that I'd like to talk about is the popularity, the growing popularity of rent control. And this is a lot like the wealth tax, where it's just a terrible, terrible idea. And that it's ironic because the very people that they're trying to help are the people that they hurt in the long run. What rent control does, or any price control, is it limits the supply of something. And especially in markets like San Francisco or New York, where you've got the rent control, keeping that down, that's going to limit supply coming onto the market. If there's less supply coming onto the market, the price of those assets are going to go up if demand remains the same. So what you're doing is, in other words, if you've got a renter that can afford $2,000 a month in rent, and you're capping that at the rent at $2,000 a month, well, okay, so they might be able to afford a $2,000 a month rent payment, but they're never going to be able to afford to actually buy, because there's not going to be any more, or there's going to be very little new supply coming onto the market, because it doesn't make financial sense to rent out those units if that's the goal of the owner, because they've got that cap on rents that's going to limit the amount of return that you get on your overall investment. So you look at markets like San Francisco or anywhere really, they always talk about how supply is low, supply is low, supply is low. Well, yeah, it's going to get a lot lower if you put in rent control. So going through this, you can see that Even 5 years ago, you had rent control, I think, in San Francisco, New York, but it wasn't really popular throughout the country. Now they're talking about it in Berkeley, Chicago, Washington, D.C., Westchester County, Minnesota, New Jersey, the state of Washington, Hawaii. All of these people, or all these states, are jumping on the rent control bandwagon. So what does this mean for real estate investors? First and foremost, it means stay away from any of these states that are even considering it. I mean, don't even waste your time. Go into these linear markets that I always talk about in the Midwest or in the South, Missouri, Indiana, Kentucky, Tennessee, something like that, because these states are going to be the last states to implement rent control. That's not to say that they won't. And I think that, especially if you get a Democrat in the White House in 2020, that I would say that there would be more than a 20 or 30% chance that if you get a Democrat in the White House in 2020 and they're there 8 years, that within that 8 year time frame, that there very well could be a federal rent control. And that's probably totally against the Constitution. But as of the last 30 years, they don't really pay much attention to the Constitution, unfortunately, anyway. So, everyone, I won't go into that. Everyone thinks it's a fluid document, which it's really not. But the bottom line is this could be implemented federally. So this is super bad news for buy and hold investors who are trying to rent out their properties. But it is good news for people who are really focused on the capital gains, because it would put a lot of, obviously, it would put a lot of headwinds on rents, but it would also give a lot of tailwind to prices, especially if you're in one of those linear markets where you're buying under the cost of construction, because not only does it not make economic sense now because the inflation of construction costs have gone up so much higher than the prices in some of those markets, that buying under the cost of construction is definitely a reality. But if you added this on top, that would just be fuel for the fire for those starter homes in there. The 3 bedroom, 2 bath, 1,200 square foot house that you can buy for 150 grand, when the current construction costs are about $150 a square foot. So my suggestion here, above and beyond just really pay attention to this, is stay away from any of these states that are considering this nonsense, and that's generally the blue states, and really allocate your attention to these linear states where this is a lot less probable. But pay attention to what they're saying, because this could be implemented nationally sometime, within the next few years. And what I would say then is to make sure that you've got a diversified portfolio. And I say this all the time, but it's not just diversifying between Kansas City, Indianapolis, and New York. You still got, to a certain extent, you got all your eggs in one basket. When you look at your government risk and you look at your currency risk, it's still U.S. and it's still denominated in dollars. Why not take some of your portfolio, and it's different for every person. I suggest 50-50. That's what I do for myself, and that's what I suggest for all my friends and family. But maybe it's different for you. Maybe it's a 20-80 split or a 30-70 split. But it just makes sense to get your money, some of your portfolio, outside of the United States, in a country where this type of nonsense isn't even on the radar, and also where you're getting a currency that's really cheap relative to the dollar. There's very little downside in having that strategy, because you can get just as good at returns on long-term rental properties, such as in Colombia, that you can in the United States. So, why not have a plan B there, and why not be hedged? That's really the takeaway from what I wanted to, or with this rent control idea that I've really noticed pop up lately, and I saw a lot of headlines for last week. So that's the show today. I'm going to try to call it quits a little early, just to kind of give my voice a rest. Make sure you guys subscribe and hit the like button if you guys enjoy this content, because I'm going to be doing this every single Saturday. And I've kind of rebranded it the Macro Show. It was the George Gammon Real Estate Show, but I think macro is more important, or a better way to describe the show. And I think it's just super, super important, because the more I talk to real estate investors, the more I see that they're really, really good at analyzing things from a bottoms-up approach, but they're really bad at analyzing things from a top-down approach. They don't even pay any attention to it. A lot of times, as we found it throughout history, and especially through the GFC, we see that a tops down can overwhelm the bottoms up. So from now on, the Macro Real Estate Show hosted by George Gammon. Thanks for watching, guys, and we'll see you next week.